Welcome to the Fahmy channel. Today I'm going to show you how to read a tax return. Alright guys, let's jump into it. So for some reason a lot of people don't know this, but this is the first page of your federal income tax return. As the name says, we're taxed on our income. If your friend gives you a loan, that's not income. If your friend gives you a gift, that's not income. If you refinance your house and get loan proceeds, that's not income. You're only taxed on income. Next, we have our filing status. There's only 5 of them, and we have single, married filing jointly, married filing separately, head of household, and qualifying widower. Now, the question that I get asked often is, if you're single, can you file as married? And vice versa. No. If you're single, the only options you have are single, or if you have a qualifying dependent, you can be head of household, which has a more attractive tax rate. If you're married, you cannot file as single. You can only file married filing jointly, married filing separately, qualifying widower if your spouse passed away in the last couple of years and you have a qualifying dependent, or head of household if you live away from your spouse for more than 6 months during the year and you have a qualifying dependent. So those are really your only options. Next, we have the very basic information, your name, social security, address. Now keep in mind that you can't just make up a name. Your name has to match your social security card. Otherwise, your return will get rejected if you submit it for e-filing. So even if your friends call you a nickname, you have to put your legal name, and that's the name that's on your social security card. Now, as far as home address, people like to ask me all the time, can I just put any address that I want? You're really supposed to put your home address. Of course, if you don't receive the mail, then the IRS does allow you to use a PO box. But there are certain rules and requirements that you have to follow. Next, we have this very beautiful question asking about if you have a financial interest in virtual currency. The reason why the IRS asks this question is because they want to heavily scrutinize people that invest in, Bitcoin or Dogecoin, and they made a lot of money. They're not reporting it. So this question is actually designed to track those people and see if the IRS wants to have any further inquiries or audits. Next, we have some basic information about if you can be claimed as a dependent on a tax return, or your spouse can, or if your spouse itemizes. And then just under that, we have a question about if you were born before 1957 or if you're blind. Now, the reason why these questions are all important is because these all have an impact on your standard deduction. So if you can be claimed as a dependent or your spouse can, that's going to affect your marital standard deduction. Secondly, if your spouse itemizes on their tax return, you can't take the standard deduction, you will have to itemize. And then lastly, if you're born before January 2nd, 1957, or you're blind, or your spouse is one of those two, then you are entitled to a higher standard deduction. The next section is regarding dependents. So if you're taking care of your mom or your dad or your brother or a child, this is where you're going to list their name, their social security number, the relationship to you, and designate if they're eligible for the child tax credit or the credit for other dependents. So line 1 is where you're going to put wages, salaries, tips, and if you have foreign earned compensation, for example, you're working for a foreign employer and they don't issue a W-2 because that's not the proper form in their country, you'll also put your foreign earned compensation on line 1. Lines 2 and 3 are for interest and dividends. Now keep in mind in line 2 that even if your interest is non-taxable, you still have to report it to the IRS, and you'll usually get a 1099 INT form. As far as dividends go, if you've held the stock for more than a year, you'll be able to benefit from the qualified dividends tax rate. Otherwise, if you've had the company for less than a year, you'll be paying ordinary dividends tax rate, which is just taxed at your ordinary income. And those are for companies that you've held for less than a year before they issued you the dividends. My other note here is that if your interest and dividends are more than $1,500, you'll have to attach Schedule B. And I'll be showing that in my next slide. So here's Schedule B. There's nothing to be intimidated about. What they want you to do is pretty much itemize all the payers that you received interest from on the left, and then on the right, you're just going to put the amounts that were paid to you. Part 2, that's really for your ordinary dividends. Again, you're going to do the same thing for everyone that you receive a 1099 DIV form or a 1099 consolidated form that has all dividends paid to you. You're going to put that on the left, and then you're going to put the amounts on the right. And then this will all flow into the face of your return, which was our previous slide. Part 3 is fairly important. So if you have a bank account overseas, or you were involved in a foreign trust, whether you're a beneficiary or a grantor, meaning that you put money to form a foreign trust, you're going to have additional filing requirements. Okay, back to the face of the return. Line 4 is for IRA distributions or IRA rollovers. For example, if you do a backdoor Roth where you convert a traditional IRA into a Roth IRA, or you take money out of your IRA, and use it for personal purposes or medical expenses, that's going to go on line 4. Now, keep in mind, non-taxable and taxable IRA transactions are going to go on line 4. On line 5, that really deals with pensions, annuities, 401ks. Line 6 is for Social Security benefits. Now, keep in mind that some of your Social Security benefits may be non-taxable, and a portion of it could be taxable depending on your income. Line 7 is for capital gains. Capital gains really apply to the average person where, let's say they're selling a house or they're selling stocks or bonds. Of course, most people have to file Schedule D, which we're going to see on our next slide. So this is our Schedule D. This is where we're going to summarize all of our capital gains and capital losses. Well, if you've held Apple stock, for example, for less than 1 year, you're going to put that in part 1. It's going to be a short-term capital gain or capital loss. Now, the calculation for a capital gain is fairly simple. You take your selling price of what you sold the stock for or the security for, and then you take the cost basis, and the difference of those will be your gain or loss. You're going to notice, for example, line 1B or line 2 or line 3. 1B is analogous to line 8B, line 2 is analogous to 9, and then line 3 is analogous to line 10. These are pretty much all the same thing, but these are all different reporting requirements. For example, when you have line 1B and it says totals for all transactions reported on Form 8949 with box A checked, all these transactions on this line mean that the IRS received a 1099 form that shows exactly what your sales price was, as well as your cost basis. So if you put any number that's different from those figures on line 1B for a short-term capital gain or line 8B, you will automatically get a notice because it will not match their computer systems, and most likely you'll have to pay a tax, like an additional tax or an interest or a penalty for misreporting it. Line 2 and line 9 are similar to line 1B and line 8B, except the IRS has sales transactions for you. For example, they know how much you sold your stock or your bond for or your financial security or capital asset, but they don't have the cost basis. Now again, if you don't report the sale, you'll get a notice or you may get audited from the government. And last but not least, line 3 and line 10 are for capital transactions. For example, let's say you sold a house or you sold a stock or you sold a bond where the IRS does not have any information on the sales price or the cost basis. That's going to go on line 3 or line 10. 4 and 11 are sort of outside the scope of this video, but pretty much these lines are just for short-term or long-term capital gains of more advanced financial securities or derivatives, for example, stock options or casualty theft and losses. Next, if you have a capital gain, for example, you're a general partner of a partnership or you're a shareholder of an S Corp and there's a capital gain on that tax return. Of course, there's no federal income tax on partnerships or S Corps or certain trusts, so you'll get a K1 and then you'll pay the tax on your individual tax return. And the short-term transactions will go on line 5 and the long-term transactions will go on line 12, and that's where you'll ultimately pay the tax. If you had a short-term capital loss carryover from the previous year or a long-term capital loss carryover from the previous year, that's going to go on line 6 and line 14. So line 7 and line 15 are pretty much totals. For example, on line 7, you're total all your short-term capital gains and losses. On line 15, you're going to total all of your long-term capital gains or losses. Now, keep in mind that if at the end of this you have a net short-term capital gain, you'll be paying ordinary income tax on it, similar to what you would pay on your W-2 wages. If you have a net long-term capital gain at the end of this, you'll be paying the lower capital gains rate on your net long-term capital gains. And then if you have at the end of this, if you have a capital loss, only $3,000 of it can be used against your ordinary income, for example, W-2 wages or rental income. Otherwise, you'll just keep rolling forward the difference. For example, let's say you have a $100,000 capital loss. You can use $3,000 against your W-2 wages this year, and then next year you'll roll over $97,000, and that will happen every year until you use up all of your capital losses. Line 8 is a pretty much catch-all for other income. We're going to be exposed to Schedule 1, which is going to show you all the other sources of income This is our Schedule 1, and pretty much lines 1 through 8 are going to be summarized, and then on line 10, wherever that total is for our income, that's going to go back to the face of the return. But I do want to do a little bit of a deep dive here. Line 1 is going to deal with your taxable refunds. For example, if you took the itemized deductions year after year after year, and you took a deduction for your state income tax, and now you have a refund from that same state, that's now going to be taxable. Next is line 3, which is your business income or loss. Now, keep in mind this business income or loss is not for all businesses. It's strictly for sole proprietorships or single member LLCs. The top part of Schedule C is informational. You're going to put your first and last name at the top. You're going to put your social security number, what your business does, what the NCAIS code is for your specific profession. If you have a separate business name, you're going to include that. If you have a separate federal tax ID, you'll include that. Now, sometimes you're asked, are you being taxed at your cash basis or as accrual basis? That's going to be on line F. And that's a very important question because that could have a big impact on your taxes if you report your income and expenses one way versus another. Line G is for material participation. We don't really have to worry about that for now. Line H, if you started your business or you acquired this business in 2022, you're going to want to let the IRS know. And then line I and J is pretty much an informational question that helps the IRS track. Are you being honest? Were you required to file a Form 1099? And if you're required to file a Form 1099, did you in fact do it? And you always want to report this openly and honestly, because otherwise if you do get audited and they find out that you reported this incorrectly, you can get stiffly penalized. Part 1 is for reporting your gross revenue, and if you're in the business of selling products, you're going to also report your cost of goods sold. So Part 1 is a very important line because that just shows all the money that you received from all sources. If you're in the business of selling products, you may be keeping track of inventory, in which case you'll put the inventory at the beginning of the year, what inventory purchases that you made during the year, any applicable costs of labor or materials and supplies, and then you'll also report the inventory at the end of the year. And basically the formula is beginning inventory plus purchases minus your end of the year inventory count. That's your cost of goods sold during the year. Now, keep in mind that's one way to do it. Another way to do it is just by expensing your inventory just as you make the purchase. You don't even have to do a beginning of the year inventory count or the end of the year inventory count. Just expense inventory as you go along. Part 2 of the Schedule C just has to do with expenses. All expenses that are necessary and ordinary for your type of business can be deducted. You'll see the IRS has some general suggestions. For example, you have advertising, car and truck expenses, depreciation, legal and professional fees, and so on. If you have a vehicle that you own, you're going to have to file Form 4562 to claim the depreciation. However, if you are leasing a vehicle, you're going to have to note when did you start using this car for business purposes. Well, if you're using it partially for business and partially for personal, you want to know how many miles you drove for business, hopefully if you've kept track throughout the year, and how much you've been driving for personal. And this is important for 2 reasons. One is going to prorate your deductions. For example, if your business mileage was 6,000 miles during the year and your total miles was 10,000 miles during the year, you'll get 60% off your gas, your lease payments, repairs and maintenance, and so on, subject to certain limitations. Otherwise, if you're doing the standard deduction, then you can get about 60 cents per mile as a deduction against your Schedule C profit. Any other expenses that are not included on the face of Schedule C will go here. So for example, let's say you're a doctor and you have continuing education, you don't see the applicable expense on the face of Schedule C, you can put that here. Line 30 is used exclusively for the home office deduction. I'm probably going to do a whole video on this, to be honest, because there's so many things that people are missing out on. But line 30 is where you're going to put all of your home office deductions as a sole proprietorship. So once you've deducted all of your expenses against your revenue, you're going to have a profit or a loss. Now, if you have a profit, 2 things are going to happen. You're going to be paying ordinary income tax on it, and you'll be paying self-employment tax on it. Otherwise, if you have a loss, you have to do additional analysis to see if you have any loss limitations. Otherwise, that loss can be used freely against W-2 income, interest, dividends, capital gains, and so on. So back to our Schedule 1, of course, Schedule C was going to flow into line 3, but on line 4, that's where you report the sale of any business assets. For example, if you were a Schedule C filer, you have a small business, and let's say you sold your car or you sold some equipment, that would not be a capital asset. That would be the sale of a business asset. That would go on line 4. If you have income from rental real estate or royalties or a partnership or an S Corp or a trust, that's going to go on Schedule E, and we're going to do a deep dive into that as well. So this is our Schedule E. In part one, we're going to put very basic information about the source of the royalties received, if we have any royalties, or if we have a rental property, we're going to put basic information about the rental property, for example, the address, how many days it was rented out, and so on. So notice this form is kind of in a similar format to Schedule C. So lines 3 and 4 is pretty much going to be the gross income from rents and royalties, and then 23A and B is going to be a summary of all of them. So all the expenses related to your royalty income or your rental income is going to go in line 5 through 19 for each property or each source of royalty income, and then line 20 is going to be your total expenses. And then line 23, C through E is just going to be the totals for each of these items. For example, line 23C is for your total mortgage interest, or line 18 is going to be your total depreciation. And then 23 is going to be your total expenses for all properties. Once you deducted all the expenses against all of your income for each activity, you're going to summarize all the income on line 24, you're going to summarize all the losses on line 25, and then on line 26, you're going to combine the two. Now, if you have a net profit at the end of the day, you're going to be paying ordinary income tax on it, and that's going to flow into Schedule 1 as well as the face of the return on Form 1040. Now, if you have a loss, some of the loss might be limited. You might be able to take the whole loss. It just depends on your unique circumstances and your professional status. But that would go on line 26, and additional forms may be required to determine how much of the loss you can take. Part 2 is dedicated for reporting income from K1 from a partnership or an S corporation. So if you're a general partner or a limited partner of a general partnership or LLC or a limited liability partnership or a limited partnership, or if you're a shareholder of a corporation, you get a K1, this is the section where you'll be reporting all the applicable information. Part 3 of Schedule E is dedicated to income from an estate or a trust. So if you're a beneficiary of an estate or a trust, this is the section where you'll be reporting the income from that or the loss from that activity. If you are a residual holder of a real estate mortgage investment conduit, then you're going to have to file a form Schedule Q, and that's going to get flown into Part 4 of Schedule E, but this is not going to apply to the average person. If you have farm rental income, then that's going to go on line 40. So once you report all of your rental income and expenses, and you report all of your K1 income, line 41 is going to be a summary of that, and that's going to flow back into our Schedule 1, which we'll see in the next slide. Now, line 6 is going to be for farm income or loss. Now, this should not be confused with the Schedule E, because that was for farm rental income, whereas line 6 is for farm business income. Line 7 is for unemployment compensation. You get that number from Form 1099-G, which will be issued to you by the state that you applied for unemployment. And usually the government has allowed you in the past years to take $10,200 off and not pay tax on it. But anything over that, you'll be paying taxes on, and you'll have to report that on line 7. Line 8A through 8C is pretty much the catch-all. Anything else that's taxable that is not covered by 8A through 8P, you're going to itemize that and put that under line 8C. Now, line 10 is your summary of all of your other income from Schedule 1, and that's going to go to the face of the return. Now, at this point, we're on line 9. We've reported all sources of income, and now we've arrived at our total gross income. Now, this is not our adjusted gross income. This is our total gross income. Before we get to our adjusted gross income, which is a very important figure as it limits certain deductions that we can take, for example, medical expenses, which we'll get to later on Schedule A, there's certain adjustments that we can make, which is going to be on Part 2, Schedule 1, which we'll get to right now. These are your total expenses that you can take that are going to reduce your total income to your adjusted gross income. If you can't find a Schedule 1 adjustment that's going to apply to you, you would put that under line 24Z. And then, of course, the total of all of these Schedule 1 adjustments are going to go on line 26, and that's going to flow into your 1040. So now we're on line 11. We've calculated our adjusted gross income. And this number is very important because, again, a lot of numbers in your tax return are limited by this number or based off of this number. Additionally, you might get this question a lot, for example, if you're applying for Covered California or health insurance through the marketplace, or maybe you're applying for a mortgage. They're going to ask you what's your adjusted gross income, and it's very important that you know that this is line 11 on your 2021 tax return. Line 12 is going to be your standard or itemized deductions. So just for existing, you get a standard deduction based off your filing status. Now on the left, you'll see if you're single or married filing separately, you get $12,550. If you're married filing jointly or you're a qualifying widower, you get $25,100. If you're head of household, you get $18,800. And These can change or go up depending on what you put at the top. For example, if you're claimed as a dependent, or if your spouse itemized, or if you're blind, if your spouse is blind, or if you were born before 1957. Now, of course, you're going to pick which one is higher. So if your itemized deductions are more than your standard deduction, you're going to itemize. Otherwise, you're going to take the standard deduction. Now, these are your itemized deductions. There's only a handful of items that you can take as itemized deductions. So we're going to start off with our medical and dental expenses. Line 1 is where you're going to put all of your medical and dental expenses. Line 2 is where you're going to put your adjusted gross income. And keep in mind that there's a 7.5% limitation. So we'll note that for medical expenses, you have to have a lot of medical expenses or very low income in the year that you're going to be deducting medical expenses. Because, for example, let's say your adjusted gross income was $100,000. Everything above $7,500 would be deductible in that example. So if you have medical expenses of $9,000, only $1,500 would be tax deductible. It sucks. I think they should reduce it, but I'm not in Congress, so it's out of my hands. Then there's the taxes you paid. Now keep in mind, this is generally limited to state and local taxes. For example, if you pay state income tax or property taxes or sales tax, that is going to be what you're going to put under this taxes you paid section. And you're really capped at $10,000. So if your property tax in California is $10,000 and you pay another $20,000 to the state of California in income tax, that's going to total $30,000. Only $10,000 of that is going to be deductible for an itemized deduction. Next, you'll have your mortgage interest. Now, keep in mind, this is really for a primary residence or a second home. You'll generally figure out when you got your mortgage, and then based off of that, you can take an interest expense on the first $750,000 or $1 million mortgage balance. So, for example, let's say you got a mortgage this year, or let's say 2021, and it was for $1 million. So 3/4 of your interest will be deductible, and unfortunately, the remaining 25% will not be deductible. And this is across all mortgages for your primary and secondary home. Doesn't matter if it's your first mortgage, your second mortgage, your third mortgage, your 17th mortgage. You average all of your mortgages and you prorate the interest based off of that factor. Next, we have gifts to charity. So this is a very fun tax deduction. So of course, if you donate money to a church or a nonprofit organization, then you put that on line 11 if it's a cash contribution. Now keep in mind that you could literally take $1,000 tomorrow and give it directly to a homeless person, and that would not be tax deductible. You'd have to give it to a non-for-profit organization that is a 501c3 or a church or religious institution that's certified by the IRS. Next, if you give physical goods, for example, you donate food to charity or you donate a table or clothing, then that's a non-financial contribution, and that would go to line 12. Now, if it's more than $500, you have to file Form A2A3. Otherwise, if it's below $500, you don't have to worry about it. Charitable contributions you could not take in previous years. You can generally roll that over until you finally use it. And then line 14 is obviously your total. Line 15 is for casualty and theft losses. Now, this has been greatly limited over the years, so most people won't benefit from this. But for example, if you were involved in a federally declared disaster, usually areas that have been hit by a hurricane or an earthquake or a flood, then you can file Form 4684 and then take certain deductions for casualty and theft losses. Next, we have other itemized deductions. There's a handful of these that I'll provide a link in the description below. And then last but not least is your total itemized deductions. So again, you'd want to compare line 17 against your standard deduction. Whichever one is more, you'll be taking that on your tax return. 12B is important to note. So a lot of people think that you can't take charitable contributions if you do the standard deduction. However, if you do take a standard deduction, you're limited to about $600 if you're married filing jointly, and you can put that on line 12B. Now, the qualified business income deduction is a very important one. I would encourage all small business owners, if they are getting a K1 from a partnership or an S Corp, or if they have a Schedule C business, to make sure that their qualified business income deduction is being taken properly or computed properly. But the max you can take here is 20% off of your business profits and not pay any federal income tax on it. Now, of course, there's limitations. Line 15 is your taxable income. So once you have your adjusted gross income, you deduct your standard itemized deductions and your qualified business income deduction if applicable. That is your taxable income. Now, line 16 is going to be your tax. This is going to include your capital gains tax, your ordinary income tax, and other taxes if you make certain elections. For example, if you have a child that has interest and dividends, they're generally required to file their own tax return. However, if you're the parent, you can make an election to claim their income, their interest, and their dividends on your tax return. Now, of course, line 16 can be a little misleading. There's other taxes that we have to consider. For example, the taxes that get computed on Schedule 2, line 3. That deals with two types of taxes. One of them is your AMT tax, and that's for generally people that have stock options or they're aggressively taking depreciation deductions. But if your AMT tax is higher than your ordinary income tax and your capital gains tax on your ordinary Form 1040, then you'll be paying additional AMT tax. If the government gave you too many premium subsidies for health insurance that you weren't entitled to, whatever the overage was when you get your Form 1095A at the end of the year, you'll be paying that excess tax on line 2, and then of course this will flow to the second page of your Form 1040 that we were just at. Now, lines 19 and line 28, this is really the whole point of why you want to have a dependent, whether they're a child or a parent or a cousin that you're taking care of, because lines 19 and line 28 are tax credits that you can get for claiming them as dependents. Now, on line 20, you have your non-refundable tax credits, which we'll get to. These are a list of non-refundable credits that you're entitled to, assuming you meet the criteria. Keep in mind that these are non-refundable credits. So if your tax in that year is 0, and let's say you're eligible for a $7,500 qualified electric vehicle credit, you're getting 0 tax benefits for it. There's literally no point, because the non-refundable credit is non-refundable. You cannot get a tax refund as a result of it. Like, your tax cannot go below 0. However, if your taxes are like $15,000, then your $15,000 tax will get reduced to $7,500 in my example, and you'll actually get a refund as a result. Line 23 is for other types of taxes, including the self-employment tax, net investment income tax, Medicare tax. Now, line 24 is a big one. This is your total tax after applying non-refundable tax credits. So a very important figure. You want to be able to pull up your second page of your tax return and be able to pull this number readily available, because lenders do ask it. And you might be asked for it from other financial institutions in the future. Okay, now we're going to get into tax withholdings and tax payments. So line 25 is federal income tax withheld from your W-2 or a 1099 or any other tax form from any other person that's withholding federal payments from you. Line 21 are for your quarterly estimated tax payments that you may have paid during the year. That should be applied to tax year 2021 or the year that you're in. Or if you elected to roll over a federal refund from the previous year, that would also be included in line 26. Line 27 is for the earned income tax credit. If you're a low income individual, you may be eligible for the earned income tax credit, and that would go under line 27. Line 29 is for the American Opportunity Tax Credit. Again, if you paid for the first 4 years of college, you may be eligible for the American Opportunity Tax Credit for yourself or for your qualifying child. Line 30 is for people that should have gotten the stimulus check, the third stimulus check specifically, because this is the 2021 tax return, and they just didn't get it. Now, if you're still eligible when you're filing your return, you can get this as a tax credit here, and it'll be as if you got the check through your taxes. So line 31 is from Schedule 3, line 15, which we're going to get to in the next slide. So these are for other types of payments or refundable credits. So again, a refundable credit means that if your tax is 0, these refundable credits can take your tax below 0 and ultimately result in a refund. So for example, a net premium tax credit. So if you're eligible based off of your income for more health insurance subsidies that you didn't claim originally when you were applying for Covered California or other health insurance subsidies through the government, you can get them as a tax credit here. Or if you filed an extension, that would go on line 10. Or for example, you're switching jobs and you overpay your Social Security tax, you can get that as a refund here. And there's other refundable credits. Otherwise, if it's not included in line A through H, then you would just itemize it on line Z. Now, line 33 might look misleading. It's total payments and refundable credits. So it's not so much how much you paid. Specifically, it can also include tax credits as well. If your total payments and credits are more than your total tax, you're owed a refund. Congratulations. Then you have 3 options here. 1, you can take it as a check through the mail. 2, you can get it as a direct deposit, in which case you have to provide your routing and account number. Now, you always want to triple check your routing account number before signing off on a tax return, because you want to make sure that any refund that you're entitled to is going to the proper account, and you have to specify if it's a checking account or a savings account. Your third option is whatever refund you get, you can apply that towards your next year's estimated taxes. Otherwise, if you're not owed a refund, then you have to pay the tax. And then of course you have a handful of options. 1, you can pay the tax in full. 2, you can do an installment agreement. 3, you can do an upfront compromise depending on your circumstances. Or 4, you can just wait for the government to put a lien on your account and institute more collection actions on you. If you want your preparer to be able to speak to a third party, you're going to want to check the box yes and include their name, phone number, and PIN number if they have an applicable one. And then last but not least, if you're paper filing your tax return, you want to make sure that you and your spouse sign and date the return, as well as put both of your occupations, phone number, and email address. And then lastly, if you've been a victim of identity theft, you can request the IRS to provide you a PIN, and no tax return will be able to be filed with your name or your spouse's name unless that PIN has been entered into your return. So this is one way to ensure that the fraud or identity theft does not occur again or doesn't occur in the first place. And then last but not least, make sure that your preparer puts their name, they're signing their return, they're putting the date, their PTIN, which is the preparer tax ID number, their firm's name, their firm's address, and the firm's EIN. This makes sure that the preparer is not just filing a dubious return. They're putting their name on the line, and if anything goes wrong that they're not doing properly, they will also be responsible.